Hello subscribers, Dan here from Master Trader, and just wanted to give you a bonus lesson here on a trade that came up last week. And it's going to center around when we have a bullish option strategy, is it better to buy bullish call options or sell puts as an income trade? As you know, everything in our approach starts with a bias on the charts, and how bullish or bearish you are will dictate whether we recommend a directional trade or income trade. This was a trade, Tasty Trade recommended the other day, so we had a subscriber send it to us and ask our opinion on it, and that's why I thought it would be a great lesson to walk through the math on two different bullish option strategies. They recommended buying so the stocks at this day was trading at 118.59. So they're buying an in-the-money call and selling an out-of-the-money call. So that's our bull call debit spread, 38 days to expiration. What is TLT or the bonds? So let's look at the pattern. It's a consolidation in a downtrend, both on the daily and weekly, but it's been building up a lot of sideways consolidation for over a month, and this breakdown failure and snapback and consolidation sideways is a positive sign. So yes, it's a short-term bullish pattern that you could do a swing trade for a bounce, but it's not our style. We would not recommend a bullish directional trade on this. Instead, it looks like a short-term bottom. Our approach would be at Master Trader of just selling a shorter term out of the money bull put credit spread. So let's continue. Now we're going to analyze these two trades in great detail, and you're going to see that there's no right answer, but it all comes back to how bullish you are on the pattern and the different reward to risk characteristics of these two trades are drastically different. Let's continue. Here is the bull call debit spread that they recommended using their numbers and the closing prices. So it's a directional trade, but with positive theta. What does that mean? And we recommend these trades all the time also for the same reason. So we're buying an in-the-money call, selling an out-of-the-money call to take in premium to lower our cost basis. So we do get a little bit of cushion, and I define the cushion as, you can see it down here, it's 43 cents a share. So the cushion is the amount that the stock can go against you at expiration, and you're still break even. So the 43. So how do we calculate this? The stock's trading at 118.59. Here's my debit. If you were to follow that recommendation, you always put them in at one mid price, and this is the midpoint. So it was $1.16 a share to put on this $2 wide bull call debit spread. Continuing. So what's my maximum gain on this trade? The maximum gain will occur if TLT expires above this above this short call strike price of 119. Then you're making the difference of the $2, but you paid 116 for it. So your maximum gain is 84 cents a share. What's your maximum loss? As you know, whenever you're buying options, your maximum loss is what you paid for it. So $1.16 a share. So on this, if I did a 10 lot, that would be $1,160 max loss, $840 max gain. So the return on capital, if that happened, would be my 84 divided by the capital required for the trade, 72.4%. So that's a very respectable number. But to get that, the stock has to go higher and close over 119 strike price. Let's continue now. This would be more of our strategy, that it's not a bullish directional pattern for us on multiple time frames. It's in a downtrend on the daily and the weekly charts, but sure, it could bounce. We would prefer an income trade, and we're just profiting from pure time decay as long as the TLT holds that base. So this is the risk graph, of course, and just to go back here to this one. So this a risk graph shows over time your gain and loss depending upon where the stock is. So this one, 84 cents, this is my max gain, so that's why it's $840 because I have a 10 lot plugged in here. Here's the break even and then the max loss. So the green line is static, meaning at expiration. This purple line is the estimated movement of it over time because the Greeks are calculating that. Now let's go back to this one. So so here would be a possible trade. We would short an out of the money put under support, so 117, and buy a further out of the money put to make it a defined risk trade and less buying power consumption, less capital requirement. But now we're going to see that they're totally different trades, and they're both fine. They just depend on your trading plan. What fits your personality and expectations better? But let's continue. The break even, 116.19. Let's jump down to my so how do I get my break even? It's the short strike, 117, minus the premium I'm putting in my pocket, and so that's 116.19. So compare 116.19 with the break even here of 118.16. Drastically different break evens, drastically different cushion. How do I define cushion? It's where the stock is trading right now minus the break even that we just went over, the 116.19. So that's $2.40 that the stock can go against me at expiration and before I start losing money. This one, they only had 43 cents of cushion versus 240. So massive difference. When you're just calling a short-term bottom, you can see that. This is going to be a big difference. The maximum loss in our case of this bull put credit spread is always the difference of the strike prices less the premium you put in your pocket. So my max loss is $6.19 a share. So you're thinking, well, wait a minute, that is massive. Why on earth would I do that? And you as our subscribers know that we talk about this all the time. It is the risk and probability of incurring that maximum loss is staggeringly small. So it's unrealistic. That's like saying, hey, I buy Facebook at $180, but it can I'm risking $180 a share because it could go bankrupt the next day. Well, it's not, folks. So that's unrealistic. Look at this chart. So do you think this is going to go down $8? And secondly, the way we manage open trades, our stop is under the low of this bar, of the absolute low. We're just stopping out of this. So we aren't going to be anywhere near $6.19 share loss. And as a general rule, you can use 2 or 3 times the credit as your maximum loss. So if we use, just hypothetically, if it took out the low of this, then let's just say we would stop this out. It should be around twice this, or so $1.62. So we're really only risking 1 to make 1, not 6 to 1 or whatever the math is right there. The return on capital is significantly less, 81 cents divided by 619 a share of capital required. But you see, well, two things. I use the same 38-day assumption from the other trade just to make them consistent. 13% return on capital in 38 days is still phenomenal return, where all you're doing is calling a short-term bottom, and the stock can go $2.40 against you before you start losing money. So that's it. I just wanted to show you, there's no right answer, but you see our rationale based on the chart. There's different reward to risk profiles, as you're seeing, not only in the risk graph, but also our individual analysis of every one of these headings. Hope that helped. And for those of you who have not benefited from our Master Trader weekly lessons, then it's less than $12 a month. Each one of these can change your financial future. Give great education, stocks and options, chart analysis, psychological, proper mindset, risk management, etc. Don't forget to subscribe to our YouTube channel. Happy trading, and see you next time.